All right, there was an article in a 1996 magazine ad. It was a magazine ad in 1996 from the Teachers Insurance and Annuity Association of America. It listed these prices as examples of what these things could cost in 2026. So, for example, $16 for a fast food lunch, $19,500 for a family vacation, $65,000 for a new car. And they were saying that in 1996, and of course, everybody then was laughing, going, "Come on, you're kidding me. There's no way things are going to cost that much." Those dollar amounts are not that far off the mark. I think an average new car today is a little over $50,000. So when they laughed back 30 years ago, and today, not unusual to have a 30-year retirement.
I was just shaking my head the other day, going through a fast food, which I shouldn't have been. This was before January 1st when I flipped my the calendar and then started to change my habits. But you go through a drive-through, and I got the bill just for Ange and myself, and it was like $28, and I'm thinking, holy smokes, gone are the days of the $3 value meal, right? I mean, it's crazy. It just kind of especially obviously during the COVID times and all that, we saw a huge inflation rate. But yeah, I mean, I think back to when I first started flipping burgers at Red Hot Inn in Grand Rapids, and I was making $3.35 an hour back in 86. So things have changed a little bit. Prices continue to go up.
So, you think about all this stuff about, boy, if I'm retired for 20 or 30 years, how much more things will cost as we, go through our retirement years. And so somebody said, you know what, Mitch, I need $5,000 a month and I'll be fine. That's all I need. Well, the problem is, what do you need in 5 years and 10 years and 15 years and 20 years? Inflation has got to be a factor when you're creating plans for your clients at Mitch Lyons Wealth.
Well, it absolutely is. And that's something obviously we incorporate in when we're projecting what they're going to need over a 25 or 30 year retirement. You've got to factor in the fact that there's going to be increasing prices for the goods that you need to survive on, right? Whether that's food, gas, housing, whatever it might be. And when you start looking at a 25 or 30 year period, even growing at 3.5% inflation, that's a big number. And they see that chart we show them, and all of a sudden they see their annual need go from 100,000 up to, say 300,000. They're like, whoa, what happened here? And we're like, well, we're factoring in inflation because that's a very real factor. And if you don't, you're going to be making some decisions down the road, living on less, hoping you don't live as long, or just not living the retirement you had hoped to.
So when you think about this, and so you got out of Michigan State in 1993 before heading off to Atlanta when you were drafted by the Falcons. And so that was a decade before I played college football. And so that's 83. You think of inflation in the 70s and 80s, it was double digit. You could get a mortgage on your home and it'd be 15%, and you were kind of happy that it wasn't 18%. So 2022, that 9% inflation really freaked people out. Well, people that were older like me, I think, were like, I've seen double-digit inflation before. That's not as big a deal. But there were a lot of people that had never seen inflation over 3 or 4%. And all of a sudden, it got 9%, and it kind of shocked some people. But for the people you're talking to, they would remember the inflation of what I saw in the 70s and 80s.
Yeah, no question. And certainly 22 did get the attention of people, right? Raised an eyebrow and like, holy smokes, Now, hopefully we don't have to account for 9% year over year, but those periods do pop up. And the bottom line is when you're building that plan or constructing what we call a retirement of steel, you have to, project an inflation rate. You've got to take some guesses at what that rate's going to be, right? Whether it's 3, 4, whatever, we can plug in different rates, and we can change. That's a great thing when we hop on a Zoom with somebody and we're going through that chart. We can change some of those variables and just say, okay, what if inflation did average 5% or 6% versus 3%? What does that look like, right? And having the investments in place that can keep up with inflation, or having income sources that are going to increase over time, to create that guaranteed monthly income that you need in retirement. Those are all things that we help people, do and protect against, and to solidify their retirement.
So when you're thinking about putting these plans together, because I think what you have to do for retirees, your clients at Mitch Lyons Wealth, is incredible. 2 reasons. 1, you don't know how long they're going to be alive. 2, you don't know if they're going to have health issues. Well, now we don't really know what inflation, and we don't know. I mean, if you're retired for 30 years, you're going to see the markets go up and down like crazy at times. You're going to see inflation spikes, maybe. You're going to see interest rates move. I mean, there's so many moving things when it comes to retirement, but inflation is one of those things that, do you just do, okay, it's an average, 100-year average of inflation is about 3%. We'll just keep bumping their needs up about 3% a year?
Yeah, and I tend to go a little higher than that, say 3.5, and we'll even run it at, 4.5. Just I'd rather under promise, over deliver, and we'd like to kind of stress test the retirement to make sure, hey, if we did get higher than historical, are we still going to be okay, right? And it's part of the whole puzzle, right? I mean, there's so many pieces and so many pieces of the pie to the whole retirement picture, and inflation's a big part of it. Taxes is a big part of it. Market volatility is a big part of it. So we have to look at all those things. But inflation, without a doubt, is a very real concern, and something that I don't think enough people take account of. And today they're thinking about in today's dollars, right? Oh, I've got if you're fortunate enough to have a pension, but if that pension is $3,000 a month, but it's not if it doesn't have an escalator on it or it continues to go up, what's that? That's not worth $3,000 10 years from now, right? So, creating streams of income out of their nest egg so that those income sources will increase over time and keep up with that inflation is really what we're trying to do. Get that paycheck for life that keeps paying your bills month after month, and then hopefully get a play check for life where you can go have some fun. Every day is Saturday in retirement. We want our clients to have fun and do all the things they've waited years to do and saved for and dreamed of.
So you have, I think, number one, you get clarity. Is that what? Yeah, I think that's one of the biggest things, that when people call and talk to you, you're not going to guarantee them, hey, your money's going to last forever. Yeah, you're good to go. You're going to tell them the truth, whatever you see, good, bad, indifferent. But at the end of the day, I think the number one fear amongst retirees is the fear of outliving their money. So there was that study from that old ad back in '96, but it said 63% of consumers see inflation as the number one risk. Financial advisors are more concerned about retirees outliving their savings. So is there a disconnect? I mean, inflation's something that I think, like you, that people overlook, like taxes. They don't think about RMD age and the traditional IRAs and 401ks. It could be a tax bill awaiting them, and they kind of don't think of that. How do you see all of that?
Well, again, I think it all works together, Mark, right? So inflation is going to increase the chances of you outliving your money if you haven't accounted for it, right? Taxes, if you're paying unnecessary taxes or more than you should, right? And that's where we come in and we do our Roth blueprint. And, if it makes sense, let's take a look. And does it make sense for you to do some Roth conversions over time to get more money in that tax-free bucket so that you're not subjecting yourself, potentially to IRMA charges on your Medicare, or, getting more of your Social Security tax than you necessarily have to have. So all of that works together. We're trying to optimize your retirement. And I relate it to no different than if you were going to take a cross-country road trip. You take your car into the shop to get a look under the hood, right? To make sure everything's, your fluid levels are right, your tires are inflated properly and have tread on them. You want to make sure all those things are functioning properly before you take off on that trip. And it's no different in retirement. We want our clients to enjoy the ride to retirement. We don't want them stressing, looking at the gas gauge, hoping they don't run out of money. And that's really all that it entails. If folks call in today and they set up a time to talk with us, the initial conversation is a 10 or 15-minute call just to kind of get an overview of where you are, what you're trying to accomplish. If we feel like we can help you, we'll let you know and we can take that conversation further. If you think you're all set and we really can't improve your position, we'll let you know that too. We don't want to waste your time. But it's certain, I always say this, 30 or 40 years saving for retirement is well worth a 10-minute call to at least find out and get second confirmation from a second source that you're going to be okay.